Hello and welcome to episode 14 of the Talking Central Banks podcast with me, Karan Marishi. This platform is exclusively dedicated to everything central banking, monetary economics, and policy technicals for observers across the world. Today, we will be talking about RBI's recent tweaks in the regulatory framework for the rejuvenation of commercial banking in India. In this context, we will also talk about the macro scenarios impacting this decision. Our guest tonight is one of India's leading banking and fixed income experts, Rajeev Pawar. Rajeev is the head of treasury at Ujjivan Small Finance Bank. He is one of the country's leading fixed income investors and writes extensively on markets. He is a banker with more than 3 decades of experience and has held leadership positions with domestic and international banks across Southeast Asia, India, Middle East, and Africa. He has a deep interest in an understanding of rates, credit, and FX markets. Welcome to the show, Rajiv.
Thank you, Karan. Thank you for inviting me. It's lovely to be here.
You're very welcome. So, Rajiv, starting with the global macro situation, the Fed is suggesting that it would stop running off its $6.6 trillion balance sheet at the start of December. Also, the principal payments of mortgage-backed securities will only be reinvested into treasury bills. This signals a pause or end to the tightening phase of its monetary policy. How do you see its impact on US G-Sec yields and consequent impact on Indian fixed income?
So actually, it's quite interesting. When we had the great financial crisis 2008, at that point of time, and then all the quantitative easing started. For most of us at that point of time, we had never seen, that kind of easing happening, interest rates falling down to zero. So it was new.
Mm.
But now it's been what? I mean, less than 20 years later, 15 years later, and mostly the same people, the same traders, the same investors are there in the market. So they've seen
Mm.
a quantitative easing cycle. Then they've seen that quantitative easing, you can call it quantitative tightening or whatever, you have seen that getting reversed. And now
Mm.
we're coming to the point of time where if you, closely read the last FOMC uh, meetings, or rather the conversations that happened after that conference, the press conference, you will see that they're actually talking not only of stopping this, but also maybe getting back slightly to purchasing bonds and adding into liquidity, because things are come a full circle. For them, it's something similar to India, where there's obviously, there's some issues on inflation. Inflation is not dying down for various other reasons, the tariffs, etc. But the main
Right.
thing for them is right now the whole cycle has changed. So they also
Mm.
are at a loss. Plus, there's massive political pressure out there. So yes, I think
Mm.
one cycle is coming to an end. There might be a pause, and then you'll see the other cycle where again may not be with as much of gusto as it happened in 2008, but you will see maybe some amount of bonds happening, or some part of the money getting reinvested, which will mean that liquidity will slightly increase, because there is some amount of tightness. So the increase in US interest rates, which you have seen, is not
Mm.
only driven on the basis of expectation on when the next rate cut will happen or what is the quantum of the rate cut, but there are genuine liquidity issues there also, which we also feel in other parts of the world. Because end of the day, whatever else anyone might say, the
Mm.
dollar is the predominant currency or the main funding currency anywhere in the world. So there is some tightness,
Right.
there's some genuine liquidity issues are there, which would need to
Mm.
be eased up.
Right. In the Fed's dual mandate, Rajiv, it seems they're thinking that the risks on both sides are likely to increase in the current scenario. On one hand, with the tariff rate gradually passing on to the end consumer, as inventories clear, inflation rate is likely to elevate further. And on the other hand, the likely labor market reforms, which will likely create a demand-supply mismatch in the US labor market. This, I believe, will likely have a severe impact on the productivity of the US economy. Keen to know your thoughts on this.
So right now, if I
Mm.
was reading up some speeches made by Ronald Reagan earlier, where he spoke that tariffs are very good in the short term. In the short term, you see those tax collections coming in,
Right.
and it's great for the economy. But as
Mm.
all of us know, at some point of time, the impact starts coming in, and
Mm.
you can actually experience this. So right now, initially, the collections which were there, the equivalent of tax collections for the US, they've been extremely strong. There's a lot of money which was coming in, which allows the president, allows the government to say that the tariffs are working well, money is coming in, the country is benefiting from it. Leaving aside completely the fact that the tariffs are used for various other measures, political measures, whatever. Let's leave that aside. Purely from a financial or a funding point of view or a tax point of view, the tariffs have actually brought money into the US. Because what happens when a tariff is imposed on a country? If there's a 50% tariff, and I can say this with personal experience,
Mm.
my wife has a small business which runs. There are things which are sent across to the United States and all. And when the tariffs hit immediately, the first thing has happened that whatever was in transition, whatever goods were already booked, you had to pay those taxes, whether it's 5, 10, 15, 50%. She had to
Right.
go ahead and make those payments. And
Mm.
for larger exporters, it would be much more. So those monies were paid up immediately. But then after that,
Mm.
you find some other avenues to work on it. You work within the norms, or you find out another way to do it, or you wait for things to change, or you talk to
Mm.
your consumer and find if you're your end buyer in the US, and see that if they actually have a genuine need for it, able to pass on the price, which is what has happened in this case. Many investors many exporters that I've spoken to are to a great extent been able to pass on the prices. So things
Right.
that are really valued, which is wanted out there, if somebody wants an XYZ product, whatever it might be, or which is required for them, then yes, they will pay that many extra dollars for it. If not, they will go somewhere else. So you'll see a change happening in terms of way the exports happen, say from the US, from India to the US, or from any other country going in out there. Certain things like if all those precious minerals which are there, which China sends across, if that's required, then yes, those guys will pay extra for that and take it on. But there are certain things which you don't require, then you'll probably go to another buyer, or you'll stop utilizing it to the extent possible. So you will see an impact on the US economy, and that's getting impacted on the interest rate side also. So you are seeing certain goods, the prices rising out there. So that has an inflationary impact, and that will continue until those tariffs come down or alternative cheaper sources are found. At the end of the day, it's demand, supply, and price action which is there. So you will see that happening. And on the other side, the guys who are sending it across there, India, China, Vietnam, whichever country is exporting things to the US, will also have a fallout impact of that. So while we are doing a lot to push our economy, etc., the mix of
Mm.
our exports to the US could undergo a change. So maybe priority drugs are there, things which the United States definitely requires. Yes, maybe they will take that up at whatever price, or the buyers out there be able to pass it on and then pass it on to the end user because there is insurance, etc., and they can bear that cost. But there will be some
Right.
inflationary impact of that somewhere. Things that
Mm.
don't require, maybe clothes, maybe textiles, what I do not know. I mean, I'm not an expert on that. But things that
Mm.
they don't require, maybe they'll go to a cheaper country or a country where the tariffs are lower. So that impact is going to happen. You are going to see eventually. Right now, the US economy, whatever else you do, you look at the numbers coming in. Of course, the latest, the NFP numbers did not come through in the previous month because of the lockdown, because of the shutdown of the government, which is there. But when you do
Right.
see the numbers coming out, I won't say the
Mm.
economy is overheated, but the economy
Mm.
continues to do well purely because of the price action. Something which was $100 is now $120 or whatever. So there
Mm.
is growth, or if anything else, the value of trade happening has gone up, so to speak, and the
Mm.
tax collections for the government are higher. So that impact is definitely coming through.
Right. Coming back to India, Rajiv, as a consequence of the ECL framework recently announced by the RBI, do you see any change in the credit flow to key sectors of the economy and the consequent competitiveness of Indian commercial banks, in a way impacting their return on assets?
So the ECL it's been a pretty forward-looking declaration from the Reserve Bank. In the past, we obviously it's something similar to what is happening in anything else. If you look at markets or look at anything else, we followed in the past predictive AI. You look at data
Right.
what is available, and then you make a prediction ahead to see that which way a trend is going, which way the rupee is moving, or gold is moving, or
Mm.
whatever. Now you're doing a future projection of an unexpected loss analysis, which is done, which is good. It's good in two ways. One is that you're providing for the future, so there are no surprises either for you as a bank
Mm.
or for your investors, which are there,
Mm.
shareholders, etc. Also, more importantly, it makes you think. So rather
Mm.
than you want to grow your loan book as a bank, it's not very
Right.
difficult to do it. Any lender in India or anywhere in the world, the easiest thing in the world is to lend money. You stand with a checkbook and you're willing to hand it out, people will take money. More difficult is
Mm.
getting that money back. And even more difficult, of
mm,
course, is raising deposits and funding that.
mm,
So giving out money is not difficult. If you want to ramp up your loan book, you know,
mm,
it's easy enough to do it if you turn a blind eye or turn a Nelson's eye to the kind of credit that you are taking on.
mm,
But here, it starts biting you from day one because you've got to
mm,
make a prediction. The whole framework way it works is say that what is the full expected loss mechanism is that in what
mm,
point of time will your loan go bad, or what percentage, what is the probability of it going back, and what is the hit you're going to have. There's a whole calculation which is done, and you start providing
mm,
for it right now. So
right.
effectively, you are forced actually to go for better
Mm,
credit or be more careful about whom you are lending to. Yes,
mm,
one can argue and say that this means that you are being more conservative on not looking to lend, or you will lend to better credits only, and therefore your margins will be lower. Yes, that is a
mm,
possibility. Something like that could happen. But if you notice what the RBI has done, they have announced this mechanism, but along with that, they have also reduced the risk weightages. The risk
right.
weightages for various lending has been brought down, and the
Mm,
lend and the reduction which they have done there more than offsets whatever additional you need to pay out to
okay.
additional costs that you have for the
Mm,
new ECL framework. So effectively, yes, you will be having to provide more, but you're getting more
mm,
capital also freed up. So to put it very bluntly, your return on assets might come down, but your overall
mm,
return on equity will go up because you can
okay.
do more leverage. So the same capital
Mm,
can be reutilized for that manner. So to that
mm,
extent, it's not bad. It's good. In fact, you might even free
mm,
up more capital. So banks
mm,
should be more conservative, not more conservative, but more careful in lending. Definitely, you should not be throwing
mm,
away money or whatever. There's a mix which are
mm,
there. I think every bank which is there has its own mechanism on how they look at credit, secured, unsecured, which part of the portfolio are going into, be it housing, be it gold, or
mm,
any other aspects or any other loan categories you go into. So there's a proper mix they look at.
mm,
So this mechanism is, I think, a step forward. It's an evolutionary kind of mechanism which is happening. So it's not going to
mm,
impact banks badly. I think it will
mm,
help them go across. So rather than having these cycles where there's a boom time, and then after a 3-5 year cycle you find some bank or some lender or
mm,
some NBFC or somebody is having trouble, you will have a moderate, steady kind of growth. Largely, you will. It doesn't mean that things will
mm,
always go positive, but it
right.
definitely means that you will not have those spikes. It's going to be
Mm,
more sailing, which is there, and the
mm,
credit flow will improve definitely because of the risk weightage reduction, which is there. You'll find more credit flow coming into the market, which is what the government wants, which is what banks also want. You want credit flow to go. At the end of the day, we might say yes, there's so many banks in the country and so many NBFCs, etc. But credit does not go down to the segments that actually require it. Which is why
right.
so many different mechanisms have been provided by the government to lend to various sectors.
So the framework of the ECL came into being sometime in 2023, Rajiv, if I remember correctly. But the glide path is extended beyond 27. So do you think that it would be more comforting to commercial banks that they don't have to do the kind of provisioning that was envisioned in 25, 26?
So they've given them, I think, a 5 year glide path,
Yeah.
and that makes sense because see, you have to realize that for any bank, banks are pretty
Mm,
large animals, so to speak. It takes
mm,
time to adapt to it, and banks are also highly regulated entities. Any banks
mm,
anywhere in the world. So being a regulated entity, there are various things that you need to take care of. It is not that you turn off a tap and start another one. Say this is where the calculation has to be done. You would have system changes to be done. You would have to rework your mechanism and how your frontline sales team is going to go and look at it. What sort of customers you're going to focus on. There may be some change in customers you will do out there. There may be
mm,
some different kind of products that you might want to put out. If you were, for
mm,
example, not into gold loans, you might go into that. Or if you're in an XYZ loan, say credit cards, you might move out of that, or change the mix in that, or change the geographical mix in that. So it's like
mm,
literally drawing up a new business plan, so to speak. So it may not take
right.
5 years,
Mm,
honestly, but giving that much time gives a comfort to a bank also that you are not suddenly switching lines.
mm,
It's not that you're driving X vehicle and now you get onto a new vehicle. So there's time being
right.
given to move on to it, and that's what the central bank normally has done in the past also. So it's a great positive step by the RBI, I would say. They're giving the
Mm,
banks that much time to adapt to it, and that
mm.
will work well.
Is often quoted, Rajiv. It's an argument among central bankers that because of tough regulatory norms, banks hesitate to lend to risky segments, and this opens up the space for NBFC in the economy. This simply because by nature, risk flows to less regulated spaces in search of returns. What changes do you see post the ECL implementation for the banking sector? Also, Rajiv, do you think that banks would become more conservative lenders? You did talk about this, but maybe you can probably, give more details on this. And the consequent higher risk segments migrating to NBFCs, or maybe even to capital markets?
So see, I mean, where do NBFCs also get the money from? They get it from banks, right? Yes, they get it from the
Right.
capital markets. You can raise
Mm,
equity, you can raise bonds,
mm,
but a good chunk of NBFC funding comes from
mm,
banks. So it's the bank money itself which is passing via the NBFC model and then going on to the end user. So the banks are
mm,
the ones holding the financing in the end. Will the
mm,
risk appetite or the credit appetite of a bank change? You do not need regulations like that to change it. Any bank could decide at any point of time that it wants to change its credit model. In fact,
mm,
my view is, and that is something which I think the Reserve Bank also has been propagating, is that they want specialized banks. When they
mm,
launched small finance banks, which have been, fairly successful, many small finance banks have been successful. I've been a part of one of them.
mm,
Uh, the whole model worked very well. When it was for banking for the underbanked and unbanked,
mm,
focusing on the microfinance sector and the small
mm,
borrowers. So that model worked well. I think the payment
right.
banks were another kind of mechanism which were done, which has not done
Mm,
so well. The
mm,
RBI has also spoken of having more specialized banks, which would be more focusing on corporate lending or what we popularly call capital market related kind of activity. So they open to those kind of banks. So given
mm,
how the financial sector has evolved, I think we should look at each of these lending platforms as specialized segments of the market overall. So within the
mm,
NBFCs also, you have some NBFCs which concentrate only on housing. Some are only
mm,
into the equity markets where they do margin financing, etc. There are some who take
right.
deposits and do everything. The big ones which are there who do all kinds of things. Some are
Mm,
focused for years and years. They've been there. They're only in the gold loan business or whatever. So each one
mm,
is specialized. So it's not that we can generically say all banks are one and all NBFCs are one. All banks are risk averse and NBFCs are not so risk averse. The set of people
right.
who are there are the same. The same bankers
Mm,
are going back and forth between banks and NBFCs.
mm,
The lending or the risk appetite comes from two parts. One is what
mm,
is the model that a particular organization has adapted on, how they want to
right.
grow and do the lending with segments they feel they have their strength in and they want to lend in. Like for example, if
Mm,
very logically a large company like I would imagine.
mm,
I have no privy knowledge on that. Say Bajaj or whatever, when they started the financial services business, since they're into two wheelers, probably financing two wheelers would have been a big thing for them at that
right.
time. So that's a logical
Mm,
extension. That's why you find so many automobile companies having their own NBFCs. So you find
mm,
where you have your core competencies and you go in there. And if you have a core competency there, if you are a strong lender in the microfinance space or whatever, or in the consumer durable space, then obviously your risk profile will change because you understand that market better. You're able to understand the psyche of the customer, which geography, the way it moves. Every
mm,
district in India has a different risk profile. And there are ways to map it and do that, and banks do that. There's a lot of work which goes in, not just on the asset side, on the liability side also.
right.
How is it going to work? Which state is going to work in a particular way? Seasonal changes which are there. So you work it
Mm,
on that basis. There are plenty of NBFCs. If you look at them, people will say, "Oh, this is a very, very conservative company. They're very careful on how they lend." There are big names which are there.
mm,
We would say that these guys just throw out money. So one part
mm,
is what is your understanding, your background, what is your product
mm,
profile, and what you're focusing on. The second is the
mm,
regulations, obviously. If I am
right.
if I'm a money lender sitting in a small village, I have no regulations. I can lend to whoever I want. I can lend only with
Mm,
my community, or I can lend to whoever is the next person who walks into my door, or I can lend only
mm,
to the people who are above the age of 50 or below the age of 25. Whatever I want to do, I can do. There are no regulations.
right.
Then
Right.
the regulations vary. Maybe the regulations for
Mm,
NBFCs are different. I won't say they're less or
mm,
more, but they're different from what they are for banks. So based on
mm,
that, everybody has their own lending model. Based
mm,
on the new norms which are coming in out here for the ECL, I do not see a change happening in terms of banks becoming more conservative in terms of lending. I think the banking model has survived very well for various reasons, especially the liability portion of it, because that gives them
mm,
strength. That's money which comes in. It's not an easy model to run, but that's a model which is there where you have a continuous flow of deposits. You take that
mm,
in. It also gives you a responsibility that since I'm getting in deposits, because a deposit at the end of the day, these are retail deposits. You get wholesale deposits also, but you're getting them from small consumers. So you have an obligation to look after that money. So from that point of view,
mm,
you are careful. The regulator also is careful in how that money is being lent out. because there is somebody
Right.
else's money that you are dealing with. So the profile changes. If your fund
Mm.
is coming from a loan where you have taken from a loan from a bank for 1 year and you got to lend it out, then your exposure is just to that one bank in terms of your liabilities, not to maybe
Mm.
500 or 50,000 customers, lending customers or liability customer of the
Mm.
bank. So naturally,
Right.
your lending profile or your thinking will change. So that's
Mm.
it's a model or a thinking which is there, which is different. So I would not
Mm.
generally say that because a particular new set of norms is coming, banks are going to become more conservative, or
Mm.
the riskier lending will move towards NBFCs. I'm very sure there, you have so many of these fintechs who are coming to lend. They do online lending, which is there. There's some different models that they follow. Uh,
Mm.
they have the technology to adapt it. So maybe they might go in for lending into segments which traditional lenders might find riskier. It may be risky, may not be risky, but they have better models,
Mm.
asset models, which they feel they can read, analyze the market,
Right.
and go into it. So they might go into it. So someone might say, "Hey, this is a startup, and they're doing riskier kind of lending," but they are comfortable with that, or at least they believe that they have a model which helps them understand that credit better. So if
Mm.
you have an understanding of the market, you go in for it, and you take the exposure to the extent that you have that credit appetite. That's
Right.
that's how it broadly
Mm.
works. Be it a bank, be it an NBFC, fintech, or even a small money lender in a village.
Since you just mentioned, Rajiv, that ECL is a forward-looking uh, tool, do you see any changes on the pricing of loans as well?
So I think any pricing benefit, definitely banks will pass it on to customers. That's going to
Right.
happen because there is competition. So you will definitely
Mm.
want to do that, and that benefit will come to the customers at that point of time. And
Mm.
also, like I said, because the structure is changing in the risk norms are being reduced, so you have more capital available, you can lend more. So I
Mm.
can do more volume at maybe at a slightly lesser spread. So that can
Right.
definitely be done. So you can make
Mm.
have a larger number of customers, have more
Mm.
income coming in for you, though the exact name might come down. It will again, I said, depends on the bank what they
Mm.
want to do. It will depend A on the
Mm.
market, which segment you are in and how many competitors you have out there, who's coming out with you out there, logically. Second, it will depend on what your own risk appetite is, what your past record has been in that segment, how
Mm.
have you done out there. If you're lending, say, in the MSME business and you've had a disastrous 3 years, you've not been successful in that, there is no way you'll go into that. You'll be very careful in lending out there. But if you had a great run out there, you've been very successful
Mm.
in MSME housing or whatever, then you'll be more comfortable lending out there.
Mm.
So yes, you could see some changes happening. You could see some shrinkage in NIMs, but again, it would depend on banks, etc. But overall, I think the profitability of banks or the return overall for banks, I don't see it coming down as such.
Right. The recent framework and the regulatory tweaks by the RBI also talk about the limit of for lending by banks against shares, units of REITs, and units of InvITs, which will also be enhanced while also removing the regulatory ceiling altogether on lending against listed debt securities. What are your views on this, Rajiv?
See, actually, all the years I've been working, 25, 30 years, you said I've been working. One thing which has been always propagated by everyone is that, the corporate bond market should grow, the corporate bond
Yeah.
market will increase, government securities, retail network should increase or whatever. The
Yeah.
only reason it does not grow is that because
Mm.
there isn't enough liquidity in some of those assets. By liquidity, I
Right.
mean buying and selling it. Yes, now there are platforms you can buy, sell, and do that,
Mm.
but also the ability to borrow against it.
Mm.
A good part of an equity is what I can take an equity, and most of them, if you buy and sell a stock of a liquid enough or a well-known or a Nifty 50 company, I can definitely borrow against, so I can sell the stock. Now you're increasing it across to bond markets, okay, and now
Mm.
also equity, you're increasing the limit. So it gives a person, an investor, that much more comfort. We have been
Mm.
working for years where you see all the campaigns, mutual funds are and all. We're encouraging people to
Mm.
save and invest. So there's an
Right.
asset which is being created. People have those assets.
Mm.
It's a great thing. You're teaching people to save. Earlier the norm was
Mm.
create an FD, invest it. FDs also are good, and
Mm.
the money is safe. There are returns. There are positives between of an FD over a mutual fund also for that matter. So
Mm.
the saving mechanism which is there, be it an FDs, mutual funds, etc., has been there. But you have to make it
Mm.
more liquid. Any bank you go to, if you have an FD, you can easily take an OD against it. It's not at all difficult. You can do
Right.
it online, and it
Mm.
costs a little bit more than the rate at which you have done your fixed deposit. So that liquidity is there. Many of those other investments, that liquidity was not there, or it was there in a limited way.
Mm.
For example, for
Right.
equities or against mutual funds, I think it was capped at 20 lakhs for an individual. You could not go beyond that.
Mm.
And similarly, for debt, there were restrictions. So now they've increased the limit up to 1 crore for stocks. And for listed debentures,
Mm.
there is no limit at all, which is a huge positive because you see the overall framework which is there. What is happening? Any company which wants to fund itself nowadays, some amount of the
Mm.
money comes from banks. A
Mm.
bank, if they are not happy with the banks, if you're a large enough company, you go to the capital markets. You can have a
Mm.
bond issue. Many of those bond issues are large bond issues. Again, you do a placement of that bond either with a financial issue or with a bank again, and you get money. So you're a large corporation, you manage to raise a few hundred crores or a few thousand crores.
Mm.
But you also want the avenue to be able to sell that in the retail market. The retail market, yes, a lot of companies do it, especially NBFCs. They have these smaller issues, where the yields are higher, so HNIs buy them and you buy debentures. But you want that to spread. The only way to spread is that people have the ability that, yes, I'm buying an XYZ company, maybe an NBFC, maybe a manufacturing company, but either I can sell it or I can borrow money against it at a reasonable cost. So now, if
Right.
you have that ability to raise money against it, I'm more comfortable
Mm.
investing into that. So it's actually helping the
Mm.
capital markets, it's helping flows to get back into companies that require it. So the overall mechanism which the government has announced, the government is right now pushing a lot on growth. You had your GST reductions, etc., which have been done. You have
Mm.
these risk norms which have been reduced. Interest rates have been cut. This also works in
Mm.
part of it because if somebody has to raise money either through an IPO, through equities, or through debt,
Mm.
they would like to raise it through the retail segment also at a cheaper cost because retail is at the end of the day very expensive. You have to have a public issue, there are norms, there are listing, there are all kind of other things that need to be done. But if there are more
Mm.
people willing to invest in it with the satisfaction that I'm getting something more than the next investment, say in a mutual fund or something,
Mm.
and I can also liquidate it or borrow against it easily from a bank, then you're more comfortable getting into it. So
Mm.
if I have 10 lakhs lying with me, and rather than just invest it in the mutual fund or keep it in the FD, I can do that. Also, I have one more option also to look at. Yes, I can look at this particular bond from a triple A,
Mm.
double A, whatever my risk appetite is there, and get into it, or invest into a stock also. And if the stock doesn't
Mm.
appreciate so well, I still have the fallback and I can borrow against it to a larger amount. Or right
Right.
now I could do 20, now I can do a larger amount. So my exposure is increasing because the overall size of our markets also is increasing. So logically, it makes
Mm.
sense to increase that limit. So
Mm.
from the user point of view or the borrower point of view, it's great. From the bank point of view, it's even better because banks obviously would like to do secured lending, and this is pure
Mm.
secured lending which is there. Rather than just give a loan to somebody and says, "Hey, take this and do whatever you want to do it," or somebody draws down on his credit card and then uses that money and speculates in the market. Here, at least he's
Mm.
bought stocks, he or she has bought stocks, and is borrowing against that stock. So at least I see the end use out there, and I have the collateral with
Mm.
me. And if I have adequate margins and all, which normally it's almost for every 2 rupees you'll be able to borrow 1 rupee on an
Mm.
equity portfolio, then you're quite comfortable. So from the lender's point of view, also there's great amount of comfort which is there. So these
Mm.
things, it's a positive step, and it's like another cog in the wheel, which is building towards infusing more money into the capital markets, more money into corporations who are there, so that it can get into productive uses, and you know the money cycle or the economic cycle can get pumped more.
So basically, I can say that this is more democratization of collaterals for the households.
Yeah, so we have one more option, which is there definitely.
Yeah. Another major announcement, Rajiv, was that RBI would provide an enabling framework for Indian banks to finance acquisitions by Indian corporations as done by global lenders. And this will undoubtedly increase credit flow. But the question, Rajiv, is that perhaps the timing of this move is a bit confusing. Why is it happening now?
So again, it is linked. I mean, I'm pretty excited about this move because this is
Mm.
something which I remember reading about as a kid. You had all those leverage buyouts in the West. Of course, you had, for those who are old enough to remember, Mike Milken and stuff like that, and those things went
Right.
completely berserk. The first big
Mm.
crisis on Wall Street, or the ones that you
Mm.
remember at least. So
Mm.
those things are there in your mind. Why is it happening now? Again, it fits in exactly the same way. You are
Mm.
when you want to push an economy to grow, there are two ways to
Mm.
do it. One is that you supply more money into it. So
Mm.
those all the steps we discussed so far, the cut interest rates, reduce risk weightage, cut taxes which are there, the GST, etc. They are allowing, as you said, democratization of funding which is
Mm.
coming to the markets. All that is done. Then
Mm.
what is on the other side? You want the company to grow. So what do you ask a corporation to? Hey, why don't you set up a greenfield project? Not
Mm,
very many companies are comfortable setting up brand new greenfield project today because of all the
right.
craziness which is there on tariffs, etc. So you don't
Mm,
want to start from scratch, purchase land, go through 50 permissions which are there, and I'm setting up a new refinery or whatever else is your line.
mm,
You find a business, it could be an expansion of your existing business or something aligned
mm,
to your business which you want to take over, maybe a small
mm,
unit or whatever, you would be happy to do that. But financing that is always a challenge. It would always mean I'm going back to the equity market. And a lot of these things require funding to be done, wherein you don't want to make an open declaration before you go and raise money for it. Of course, you follow the
mm,
norms which you want to follow, but
mm,
many of the IPOs you see coming today also, you also see that for undisclosed purposes, including purpose of acquiring other assets
mm,
there or other businesses.
right.
So getting a funding from bank for this, I think, is a great positive step. Again, it would do
Mm,
to my mind, to a large extent, from a lender's point of view, to be secured lending, so the banks would be comfortable to it, and
mm,
it will help a company like we are 1,000 crore company and you go to 2,000. You need to have both organic and inorganic growth. You cannot have only one because the gestation period is too long for something which is coming up. I mean, if you see in the tech field, the startups come up overnight, whatever. So if you want to do
mm,
something in the brick and mortar world, the easier way is to just go and buy out a business. To buy it, you require money. Where do the money come from? It comes from banks. Banks were never willing to fund this kind of thing because in the past it was considered, you are taking over some other business. There
right.
are laws about it. It's dangerous. What is happening? You're siding with
Mm,
one business against another business. But if there are
mm,
proper norms against it, loans can be done. If I can do
mm,
either a leverage buyout or a buyout or fund a buyout in a particular way, which is there, it could be a
mm,
friendly takeover or otherwise or whatever, then I think
mm,
banks would be very comfortable doing it. In fact,
mm,
some of it was already being done. When you look at, I won't say exactly the same thing, but any startup which is there, venture credit which is there or whatever, or any other credit or any other loans which are given when companies are starting off, they were
mm,
purely following the equity route. You have a startup
right.
which is there, you want to grow up, it's equity. You get in your seed capital, you get in the early VCs, stage one, two, three, ABC, whatever, you go through all that. Now it's like,
Mm,
I think that has benefit people a lot. So I think banks probably also want to get into the game, into that game, not as a not as a VC, but maybe probably
mm,
funding the debt, basically,
right.
or acquisition or takeover.
Mm,
And obviously, the cost out here will be very, very different. These will be at very, very attractive rates, attractive from a lender's point of view, so to speak, because you're going to acquire assets. And the tricky part will be what happens afterwards. When you acquire the business, are you going to consolidate the business? Are you going to strip it and sell it down? Are you, what is the intent of that? Because they could be ethical questions, other questions asked at that point of time, that, hey, a bank funded
mm,
someone, that guy bought a 1,000 crore company, but he stripped off the units and sold it off, or people got laid off or whatever, and the business was sold off for 2,000 crores. So good,
mm,
great return on your loan which you had made or investment you had made. So did the guy who was buying it, but not so good for the
mm,
company which was being acquired. So there could be those
right.
kind of conditions. So the norms and conditions for that will have to be laid down very carefully, especially in our country. Where the ethical element of lending, or anywhere for that matter, the ethical element in these kind of acquisitions, since we're talking about acquisition has got something to do with people. I think the end use of it, one will have to be charted out very, very carefully.
So it can be said that, Rajiv, this move will also expand commercial banks' financier role in the to the Indian money and capital markets. And will this be lucrative to the banking sector as compared to the conventional lending portfolios?
It will be, because this is slightly along the credit curve. When I'm
Right.
helping a large company, it might be a big company.
Mm,
Company is a AAA rated company otherwise, and now it's looking to acquire another company.
mm,
How is it looking to acquire it? Is it going to be a friendly or a hostile takeover? Is one part of it. Is the
mm,
business comfortable, conducive with whatever the existing business have? So these are the pre-checks
mm,
which are there. Is there something which fits in with the business? That's what you look at. Then you come down to the actual financing. What am I getting in return for that funding? Is it just a bond issued by this company on its own assets? Is it going to be on the assets of the acquirer? Or is it
mm,
something else altogether? Are they, throwing up a bunch of stock or other financial assets against
mm,
which they're borrowing? That we'll have to see. But either ways, it's a riskier financing, because it's not
right.
a project which is owned by them. You do not see the working capital. You do not see the project. It's something which they're looking to buy, and also
Mm,
to fail. That also is eminently possible. What happens in that case? Do you lose the money? What happens? You do not know. So the pricing will be very higher. You might be a AAA company, but the pricing you will get on this buyout bond or leverage bond or whatever you want to call it, on acquisition bond, might be the
right.
pricing of a single A borrower. From
Mm,
that point of view, for a bank to do its its credit due diligence will be very, very strong out there. And
Right.
it's time for the company to prove that they really have a sound plan in what they're looking to do and going ahead and in acquiring that specific target.
It has already introduced provisioning for climate risk. Since we see climate-related risk in India as well, significantly, do you think uh, the RBI is going to announce something like this in India as well?
So I think climate risk is one area where very little has been done in India. you know
Mm,
we do things like saying, okay, like government,
mm,
we have these green bonds issued, which are there, the RBI has.
right.
It's not directly linked to climate risk, but yes, these are going to be used for specific purposes. There's no benefit in those particular bonds either for the issuer or for the lender.
Mm,
So they haven't really moved. So financing any of these activities will have to have a cohesive effort and some sort of a model around it. Initially, at
mm.
least, you want people hooked onto something. Yes, everybody believes in global warming. Not everybody. Mr. Trump probably does not, but everybody believes. Most people believe in global warming,
Yeah.
and that, yes,
Mm,
we see it ourselves. If you're living in Bombay, I mean, you are in November and the monsoons are just about over. So yes, those
right.
impacts are definitely there. But how do you finance it? There has to be some benefit to an initial investor. Not everybody is sold
Mm,
on that. Some people are still driven by commercial norms. So there has to be some
mm,
sort of tax benefit or whatever is there for people
right.
to look at those kind of bonds which are there. And
Mm,
those bonds will have to come from the government, because that is something which will be
mm,
have to be top down. If those come through, then we'll see financing working towards this sector. Otherwise,
mm,
it becomes just your CSR kind of initiatives which are there. People do it to the extent that they want to do it. That yes,
mm,
this helps something, and it helps because I have a plant in that particular area and I'm helping that particular area. So then it's not really you're
mm,
doing something with a slightly vested interest, so to speak. So very little
right.
attention has been given here. Yes, other countries are far ahead, especially Europe is far ahead on this, and we
Mm,
do need to play catch on that, because at some point of time it is going to hit us. And uh, honestly, India should have been in the lead in this, because if you, as I recover all through childhood, there's always been one year where there have been huge floods or there's been a famine. It's much
right.
less and it's managed better, but that's
Mm,
always been there. So we have been hit by climate issues for years and years. So we should actually be
mm,
working towards solving those problems and making sure that we don't add to the problems. Managing our carbon footprint, etc. That's something which we should be taking initiative and doing. But unfortunately, I don't think we have done so much about it, or at least to my understanding, we haven't done
mm.
so much about it.
Regarding the risk weights on infrastructure lending by NBFCs, Uh, the RBI has proposed a principle-based framework aiming to align risk weights with the actual risk characteristics of operational infrastructure projects. This promotes better risk assessment and capital allocation, in my opinion. I was keen to know your thoughts on this, Rajiv.
So it's similar to the risk weights, etc., which they have done for banks as well. It's not that NBFCs did not have risk weights; they've been there for a long time. But
Mm,
infrastructure products are long gestation projects. I mean, they go on for a very, very long period of time. And if you go
mm,
strictly by the existing norms, and the kind of capital allocation which you will do, be very, very high. And if there's
mm,
very high capital allocation, then either your costs will increase, because at the end of the day, your most expensive source of funding is equity; it's not debt, or your leverage comes down and you will get much lesser amount of funding which is there. So which is why I
mm,
think they've come up with those new risk weightage norms. I'm not too conversant with the whole structure of that, but
mm,
overall it seems beneficial. uh, to my mind, NBFCs, the bigger problem is the funding for them, because any kind of infrastructure lending requires long-term funding, and long-term liabilities are not something that NBFCs get very easily. Even if they were to come to banks and take it, banks themselves don't have very, very long-term funding available to them. Yes, they do
mm,
have bonds they issue and some of the long-term bonds which are there. But normally your funding largely comes from your deposits, and your deposits, mostly a 1 2 year kind of deposit at best might go out to about 5 years or so. But so the funding part of it actually is a bigger challenge for them, rather than I think just the risk weight. So uh, there are multiple challenges that they will have to face in this before they can get functional on that. But it's a step in the right direction. How many NBFCs are going to be active on this? I think we'll have to wait and see how many take. There may be specific vehicles which will come in. Those have
right.
worked well. Where you have built
Mm.
up and transfer kind of models which are being used. Those models are there. Those will work. Maybe this is directed more towards those models.
Going back to the India markets, Rajiv, amidst the confusion regarding rates, Uh, What, in your opinion, is the sweet spot between growth and inflation for India? And you do talk about this very often. Just wanted to have your opinion on this.
I think we've all been hunting for it because I was looking at we have the inflation coming, India CPI coming up next week, in the
Mm,
coming week, and the expectations are that it's going to drop below 1% for the first time, or in a very long time, at least it's going to be at
mm,
0.4 or zero point 0.5. So it's like,
right.
actually zero inflation, so to speak, in the market. You talk to a person on the street, they will not agree that inflation is zero. Prices are still
Mm,
rising of various products. They will tell you. At the
mm,
same time, the bond yields are quite high. We have had interest rate cuts which have happened. We have had front-loaded cuts which have happened. And
mm,
after those cuts, which are there of 100, whatever amount of cuts that we have had, you have bonds which
mm,
are back to where they were. I mean, a 10-year bond is still hovering around 6.5 or so.
mm,
So it's not really worked out that well. So I think finding that sweet spot is important. What is the sweet spot is actually dependent upon what is it that is you are looking to achieve. What is
mm,
meant by your growth? So, like if India is waiting for a growth target, in the past we were happy with single digit kind of growth or low single digit kind of growth, which is there. Now in the
mm,
past few years we have been used to higher growth rates,
right.
which are there, and we've been able to achieve them. So the bar has
Mm,
been set higher for us continuously.
mm,
But in most emerging markets, and India continues to be an emerging market, higher growth has always been accompanied by higher inflation. I mean,
mm,
you're an economist, you would probably know these things
mm,
much better than me, but
mm,
that's the model at which has worked for us so
mm,
far. We have rarely seen, the so-called Goldilocks kind of environment where inflation has been very
mm,
low and growth has been very high.
mm,
We could say
mm,
that maybe we are getting there now because our inflation has come down substantially. It's
mm,
below the RBI or the given target of 2 to 6% is definitely below 4. It's below 2% also now. So inflation,
mm,
headline inflation has come down and growth is steady. Though of course,
mm,
uh, a lot needs to be done to keep it going because it may have been pushed up because of various other reasons which are there, all the measures which the government has taken.
mm,
Uh, but what is the sweet spot to get there? I think that's a very very difficult question to answer, and that it is not like a fixed point which you can say at any point of time. If you look at
mm,
currently, we really want to get growth going. I mean, whatever your growth numbers, whatever your GDP numbers come up, a lot of those numbers may not be sustainable kind of numbers. They may not be
mm,
numbers that are coming through. Now, at points of time, might be coming through only through the service sector, not through the manufacturing sector, or could be specific industries which are outliers and they're pulling the economy along.
mm,
We don't have a sustained, consistent growth which is there. Uh,
mm,
if you think of where has been, I have not heard of any large, big greenfield project being announced out here. For the
mm,
project, or even in terms of the service industry, is there anybody saying that we're opening some massive GCC? Yes, people increase their capacities or whatever, but there's
mm,
huge being done out here. We are setting up, employing thousands of people out here, opening up a new center which is there, and that many more investment dollars are going to flow into the country. I don't see that happening. What we are seeing is basically that consumption part of it is increasing definitely. I have reduced
mm,
GST, 1 lakh crores or whatever. There's actually money coming into the hands of people. My restaurant bill will
mm,
come down. My ability to buy a car, if I was going to buy a car, which is say what 15 lakhs, maybe I can buy a car over 20 lakhs, right?
mm,
So to that extent, it is increasing. So
mm,
that's positive in a way. But is it causing
mm,
capacity overall of car production in India to go up? I'm not sure that's
mm,
happening as well. That means we're still very far away from that growth target, which is
mm,
you do not see the RBI anywhere saying that we are done with the interest rate cycle.
mm,
They haven't said that we are into a tightening cycle right now. They said we are moving
mm,
to a neutral cycle. Neutral means, and in
mm,
their language they've said it can be either ways. We could hike, we could
right.
whatever. And there is talk that there might be a couple of more cuts happening. In the
Mm,
past, you think even say 4 5 years ago, someone has said inflation is at 0.5%, and
mm,
rates are still going to be cut further, but they haven't been done so far.
mm,
RBI is still waiting to cut those rates. People, I mean, very very amazed. Why is that happening? Or inflation
mm,
is low, but your bond yields are so high. Why haven't they come down? They should be expecting the repo rate maybe to be cut by another 100 basis, assuming that
mm,
inflation trajectory is going to continue. But
right.
neither the inflation number nor the growth number are, I think, not neither the market nor the regulators are convinced that these two numbers are sustainable kind of numbers. It
Mm,
very easily have some sort of a food crisis or whatever, which cause prices to move up. Some of it, of
right.
course, is driven due to the lower number or the higher numbers in the previous years. So there is
Mm,
some amount of statistical correction which is happening, so to speak, which is
mm,
the inflation number coming lower, which could change again
mm,
by March or April. You could see it edging up. The base fact, the base factor which is there, that could
mm,
eventually happen. Similarly, a growth
mm,
stunted very soon. All the talk right now is, we are resolving the issues on the tariffs, etc. But again, if it
mm,
just down, that doesn't go through, then what do you do? Then you go back to square one. That could happen again. So these
mm.
are very tenuous numbers. We are nowhere close to that sweet spot. So it appears
Right.
we got very low inflation, growth is staying up, but you will need to have consistent inflation staying at a decent rate, not at those 0.5 kind of thing, but inflation staying at a
Mm,
consistent rate, maybe what is
mm,
comfortable from a growth point of view, and in supporting the growth which is there across industries, and
mm,
not just the headline number. We look only at the CPI number which is there, and if you remove the food and the fuel from it, and we look at the core number, that core number
mm.
hasn't really come down, so to speak. The core number is still
Right.
holding up in terms of inflation, which is what,
Right.
even though I think the MPC looks at the headline number, that is why they have
Mm,
been sort of hesitant in cutting down rates further.
mm,
So it's not that the inflation dragon is, completely, genie is completely in the bottle and things
mm,
hunky dory. So it's absolutely a state of flux right now. So that sweet spot is still
mm.
very far away from us, I'd say.
My argument, Rajiv, was that the market is actually ignoring the discrepancy variable between the supply side and the demand side. And I think that is what is the problem right now when we are trying to assess the actual GDP number, because it seems that supply side is growing much faster than the aggregate demand side, and that is probably being shown by the growth in government expenditure as compared to domestic consumption and private expenditure.
Expenditure.
So I think what is happening right now is that inflation or the core inflation could actually grow much faster, but it is not growing because consumption probably is not that strong. Domestic consumption is not that strong, and I think that saving investment cycle, which is being driven by mutual funds, is giving us a sense that probably the economy is doing well, at least near the potential level. But apparently, the supply side is giving us all the growth numbers in double-digit nominal growth numbers that we're witnessing right now. I mean, that's my sense of things.
Well, I would agree with you. I mean, to a large extent, what you're saying is absolutely correct. You have had
Mm,
all these, new changes which have happened. Sorry, the new measures which have been taken recently by the government, by the RBI, etc., and that's been pushing short-term consumption, so to speak, and that's taking it. And you have, if you look about it, there has been no massive jump in prices, say in cars or anything else, because the supply
mm,
is adequate enough to take care of it. That means there is a lot
mm.
of capacity which is still available. It is
Right.
not that that there's a shortage or something which is coming over water. When you find that
Mm,
the demand is outstripping the supply, then you can say that there's actually growth happening. I don't know, it's a crude way to put it, but then you can say that yes, there is actual demand, and then you need to build up more capacity. So you're right to
right.
that extent that it's not going to happen. But that again builds up my argument that these are not
Mm,
sustainable numbers. So whatever growth
mm,
numbers you're going to see, these are numbers which look very nice on the surface, and that's why you see
mm.
it across everywhere. You can see the stock market seems to be decent. The IPO market, has a life of its own.
Right.
So all that money is being pumped in out there.
Mm,
As a people, we are very much driven to save. If you are
mm,
not investing into something new or whatever, then you do save the money. So salaries have kept space. I can't say that salaries have fallen down the water in some sectors, especially the tech sector, etc. They've done
mm,
well. Now, of course, it's changing. There have been a lot of issues in the tech sector, but overall, I think salaries have kept pace. So the savings also have kept space at that. In terms of
mm.
if you look at for banks in terms of deposit growth and credit growth, the CD ratios still continue to be quite high. Uh,
Right.
so there is, I think the deposit growth is slightly lesser than the credit growth in terms of percentage, but it's definitely there. So money does come into banks. Savings do go up, and mutual fund, of course, see very very good
Mm,
accretion for debt and equity funds, especially equity funds. So that has definitely been there, and that's creating an investment aura or an image which is there that this money is available and everything is great with the economy. But
right.
another way to look at it is that I'm not able to use that money anywhere else in creating constructive physical assets. Therefore, I'm saving it
Mm,
and therefore I'm putting it into financial assets. That also is an
mm,
argument I could make.
right. And what about bonds, Rajiv? Is a rally over? And will 26 be a year of equity markets, in your opinion?
Well, I hope so. I mean, I hope the rally in bonds is not over and 26-year equities, but probably
Mm,
both cannot happen at the same time.
mm,
Bonds basically, I think not I think the rate cuts were front loaded, as we all know.
mm,
And what happened is that typically, if you want the objective of those rate cuts, obviously was to have transmission, to have interest rate lending rates,
mm,
transmit across to your lenders. Now it's like how do I put it? You have a vessel and you pour more water into it. It's going to start
mm.
overflowing unless you find some
Right,
way to take money out of that vessel and store it into another tank. So when you
right.
drop rates dramatically, the intent
Mm,
was very, very good, and it's laudable completely, which was done to reduce interest rates and reduce them,
mm,
in such a large manner. But what happens is that the transmission of that takes amount of time, because
right.
once you cut rates, you cannot automatically go and reduce rates. If you're a lender, bank, NBFC, whatever, you cannot immediately drop your interest rate. Not that you don't want to or you want to protect your
Mm,
margin. Sure, you have a profit motive and all that, but you have a certain book which is there. The certain part of the book might be fixed, some of it will be floating. The floating rate will obviously come down. The fixed rates are not going to get impacted. It's the new
mm,
incremental loans that come on that you'll get, which you get priced lower to a large
mm,
extent. Generally. You'll reprice your existing book also with some lag, because whenever the
mm,
repricing date or time comes for that, or it
mm.
might be into whatever MCLR or whatever is there, or a
Right.
market linked rate. But the new book has to be lent lower. And if you have to lend at lower rates, you might have to look at a different kind of credit, because to the same lender, if I given money at X and now I'm saying I'm willing to lend to money at X point 1%, then the guy's going to look and say, okay, why didn't you do it to me earlier? Is that something that were you trying to rip me off in some way or something? So you have to look at maybe different kind of credits. You have to rework your credit
Mm,
models and see that at this particular lending, is that sustainable for me? Is it
mm,
from the point of view? And that's where your new the ECL framework will come in. That will it be okay? Is that guy be will I end up lending more to this particular person than I should because the rates are lower and because I want to keep my margins? Or is he asking for
mm,
more money now because he's getting it cheaper? Is that
mm,
particular entity or that person or whatever, especially if you're doing retail lending, will they be able to
mm,
sustain the amount of borrowing or amount of repayments that they want to do? Because whenever
mm.
interest rates drop, every bank will go in to lend. If somebody had an option to borrow from two banks, now we may have four banks to borrow from, and they're going to
Right.
compete and offer it at a lower rate. So your credit quality could get impacted.
Mm,
That can definitely happen. So my point basically is that reducing rates also needs to be done in a constructive manner. It needs to be done in a manner, which is what you see the Fed also doing. The Fed does not rush in and cut rates. Very rarely you'll see them front loading rate cuts or rate hikes for that
right.
matter. So it needs to be
Mm,
done in a calibrated manner. Number one. Number two, I think a big issue was the change in stance which happened. The stance was changed to neutral, which to my mind probably was not called for, because the impression it gave to the market, especially the bond market, was that once you move to a neutral stance from an accommodative stance, that means this is the end, like we have reached the end of the rate cutting cycle. Then of course there was a lot of talk, and banks are being convinced that you should be lending, your risk weight is having changed, etc. And obviously you
mm,
move away from putting money into bonds, etc., and
mm,
concentrate more on your credit. So to that
mm,
extent you work towards it. So
mm,
your focus or your intent on the on the bond market comes down to that extent. Basically,
mm,
end use comes down to some extent. You
mm,
focus more on not having money lying invested in say government bonds or in corporate bonds, and you look towards lending. The other thing is also, for if you are purely from the bank points of view, is your HTM book, which is there. So the HTM
mm,
books which are there, which are the longer term books for the banks, which is the regulatory book for the bank. That's where the major chunk of your bond holdings happen, and that's where you get your major kick or your major returns which come at different points of time. RBI in the beginning of the year did open market operations. They do switch operations. Now the prices at which they do this also has a very strong bearing on the market. It's very often
mm,
that they come and they sell one bond and buy a particular bond. So you might sell a bond at a market rate, related rate, but the buying which they're doing, they may not be willing to buy it at a market rate. They might want it at a discount from the market. So that
right.
then gives a signal to the market that, hey, that's being bought at a price which is maybe 50 paisa, 80, 90 paisa below the market. So is that the correct price in the market? Then
Mm,
psychologically, in your mind, that becomes like a rate signal. So
right.
one is a question of demand and supply. I think there's a lot of supply which is coming into the market. There's a lot of corporate bond supply also which is there. Some of your credit spreads have gone up for your issuers, especially NBFC issuers. There's a huge amount of
Mm,
supply because when they moved away from banking credit, obviously they went to the capital markets, and a lot of bond issuance
mm,
took place on that. And alongside, there is definitely the thing that you are at the end of the rate cutting cycle now. There may be another 25 basis next month, and
mm,
25 after that, or maybe only 25, or maybe nothing. I mean,
mm,
all three scenarios are extremely possible. So those
Right.
happens. From that point of view, the bond market has stepped away. The equity market, I think, yes, next year can definitely be the year of the equity. The past 12 months, we didn't have such great returns. If you look at I think the Nifty probably returns were single-digit kind of returns over the past year. Uh,
Mm,
there's been a lot of supply there also, the IPO market. But
mm,
overall, now you've had a lot of positives. You've had all these rate cuts, the positive rate cuts, which is positive
mm,
for them. Interest rates have been brought down substantially. So that now finally the transmission is going
mm,
to them. So your cost of funds is coming down out there. You have
mm.
all other norms which have been enforced by the government in terms of GST reduction and making it easier for them to borrow or acquire other
Right.
companies or raise money through the retail market. So that benefit is going to come through to corporations at some point of time. That more comes
Mm,
back. So definitely, I think you will see that happening in the coming year. So I think the stronger companies which are there and specific
mm,
sectors which are, you know, going to benefit from this, those sectors will definitely do well. You will see benefits coming through.
mm.
So I think I would think of 2026 as being very, very positive for the equity markets.
Since we are in the IPO season, Rajiv, do you think there is a bubble?
Well, the bubble seemed to have got burst last week or this week. I think many of the IPOs have listed at a discount, and many of
Yeah.
them they haven't lived up to the euphoria which was there before that.
Mm,
Again, it's a question of supply. We have had a crowding of IPOs. You've had large IPOs
mm,
opening on the same day. There is I think, a sweet spot out there where an IPO goes into, anything which is about 8, 9, 10,000 crores or so.
mm,
Then there's too much supply. Everybody gets what they want, and there isn't much juice left on listing. The smaller ones seem to do well.
mm,
Again, it's all a question of growth. I think we have had, I mean, without taking names, we've had two IPOs on the same day. One was a tech
mm,
startup which was there and, not
mm,
making profits through and through, but had turned around the corner this year and
mm,
doing well. And the other one is a steady, established company
mm,
going on for like tens and tens of years or whatever, has a decent growth. But
mm.
obviously, the startup one was slightly priced better, was more in demand because the story was that the older company, it had steady growth, but there's no exponential growth coming in out there. So
Right.
that is driving them. So people, the IPO market is looking for quick money, definitely. So they're looking for names where they can flip it fast and make money. There's a whole bunch of investors, obviously, who look to get into the IPO, retail, uh, uh, high net worth, whatever, across categories who want to do a short term kind of investment in it. But the market still offers a lot of good opportunities. You have very, very good names, which come into the market which you did not know. I mean, prestigious car companies have been there, insurance company. I mean, there have been names which are very, very
Mm,
prestigious name which you would want to buy. That just gives you an opportunity to get into. And to my mind, as I
right.
said, I do see equities being positive next year. The IPO market right now, because of I think supply has taken a bit of I won't call it a downturn, but it's a bit of a slowdown right now. But I see that coming back. Like any other market, it needs to be planned well and priced well. So when you start squeezing the end buyer to the extent possible, then obviously it will give up. It's a pricing of anything, whether you're pricing a bond or pricing equity or pricing a loan.
Mm,
If there is a tipping point which is there beyond which the person says, no, I don't want it. The same
right.
$100 lower, yes, it will do extremely well. You have to leave something for the market.
Mm,
As a trader,
mm,
that's which you have realized always, that you cannot make the last 10 paise or the last 1 rupee on it. You have to leave something for the next buyer. Otherwise, he or she's not going to buy it from you.
right. Agree. Finally, Rajiv, do you think that the ascendance of gold is a never-ending phenomenon in today's context? And in your opinion, do cryptos stand a chance to become an accepted asset class in India going forward?
Yeah, both your questions are connected. I think gold
Yeah.
is the old is the
Mm,
old crypto, was the first crypto that we ever had. Both have very, very
yeah.
similar kind of natures. They're not issued by a
Mm,
central bank, and the demand supply, what was not technically, I mean, it's mined, of course, but both are mined in different ways. But both, you do not have a control over them. Gold, of course, has been uh, a safe haven traditionally, and people have invested into that. But I think
mm,
what you see right now, actually, I would say the gold market has a bit of a bubble which is there because it's not just a safe haven investment, which is probably drove it initially. More
mm,
central banks buying it and more other investors buying it due to political uncertainty, tariffs,
right.
what have you. But now it's actually become an investment vehicle where people feel that the returns are there. So you have a lot of retail investors in it. The futures market is active out there. So that's driving it. So to gold to some extent, I would say there is some sort of a bubble which is there, which you'll see it easing out. How and
mm,
when it will happen, I think you will get an idea on it if you see inflation starting to rise slightly
mm,
actually, or which means that you see growth start picking up, credit start picking up in the market. Basic money going back to the regular bread and butter kind of sectors. Then you would
mm,
see it happening. It would also happen if you see more of a sustained run in the equity market, because at least in India we have seen that together. A lot of money gets parked into gold and then moves into other asset classes like equities, etc. So if you find that
mm,
equity markets are picking up, then you'll move more towards that market and get out of other assets, so-called assets which are not giving you those kind of returns. In terms of crypto, I think you have to think of cryptos in two ways. One is, will it become a currency in India immediately? I don't think so. Not for some time,
yes.
because the RBI has been very clear on that they don't
Mm,
want it to be an exchange currency, which is the same with any other commodity. Today, also, if I go to a supermarket and say that, instead of giving you 500 rupees, I'll give you 500 rupees worth of gold. Will you take it? Even if gold is up in the market, the guy probably is going to say no to me, because that's not
mm,
really a tradable, or they're not a mode of payment in the country. So
mm,
those will not be a mode of payment. Whether crypto should become a tradable commodity in the country, I think yes, they should.
mm,
It's a high risk commodity, definitely, because for various reasons. Number one, you don't have this. Our central bank doesn't have control over the supply. The second part is
mm,
all the issues which are there in terms of
mm,
how it is used for money laundering, or for money being moved out. In fact, I was talking to some people who are involved on the regulatory side and enforcement side of this, and all these digital arrests which you speak about. A lot of people you read have lost money, 5 crores, 10 crores. I read somebody losing 80 crores in Bombay. Older people. Most of the money immediately gets moved into crypto, because if you move from one bank to the other bank, eventually it can be traced and to some extent pulled back. But it's moved into crypto, where there's a break, and then it's out of the country, or even if it's in the country, it is out of the banking system, so to speak. So
mm,
long as that risk is there, you will find it difficult for crypto to be a regularly traded currency. But once a crypto is all the cryptos are there, maybe starting with the stable coins, etc. If they come onto a proper platform, a particular exchange, for example, if NSE announces they want to have a crypto platform properly regulated and monitored by SEBI, far away, of course, then you'll probably see it becoming much more popular and traded. But that time will come, definitely. It will happen. It will not be a currency. The currencies are
mm,
going to be the central bank, issued digital currencies. Those are the ones which will definitely do well.
mm,
Stable coins will pick up if they are linked to a particular other asset. But crypto as a risky investment to trade,
mm,
I see it no different from trading gold or silver or anything else. You're willing to take a punt
mm.
on a metal which is there, which you don't know. Suddenly, some reserve
Right.
might be found in some other part of the world, and the gold price will come crashing
Mm,
down. Or look at diamonds for
mm,
that matter. Now you have
yeah.
lab-grown diamonds. The value of diamonds has come down so much. So anything could
Mm.
happen in these kind of commodities. So if you're willing to take that kind of a risk, sure, you can go in for cryptos.
I think the fundamental difference here, Rajiv, is that you can have those metals and diamond in physical form,
Yeah.
but you can only have access to cryptos in a digital form. So I think that probably gives most investors a bit of a discomfort because they can't really hold that particular asset class in their hands or in storage. So probably, I mean, that's just a thought that maybe it could never really be a safe haven metal like gold. Or do you think otherwise?
So it's moved at points of time in the past few months. It has moved inversely from gold. So yes, it is not
Mm,
a safe haven. It is a risk. It's a risk asset, definitely.
yeah.
Holding it in digital form, the only way to solve that is, like, we hold
Mm,
money also in digital form nowadays. I mean, none of us keep cash at
mm,
home. At least
yeah.
most of us don't. But, but there is safety. I know that, yes, there are
Yeah.
issues with UPI, etc., people hacking into
Mm,
accounts, etc., but your money is safe in a particular bank, or it is
mm,
safe in whichever account you're holding it. So this when that safety, when those norms are there in place, that a cyber criminal cannot hack in and take away my crypto wallet, or my crypto wallet is in my control and not in somebody entry's control, then you will have comfort on that. So those kind of levels of security and safety have to be put into place first, which can only come from a central bank and from a regulative, the regulator. If that is not there, people are not going to stay away. They'll have
mm,
to. It will have to be someone said, be a regulator setting up and saying, "Ki crypto अच्छे हैं." Then he'll have those guys
mm,
getting into crypto. Otherwise, it's not going to happen.
yeah. Mm,
You have tons and tons of retail investors currently in India also, I believe, who invest into cryptos, and they trade on the
mm,
various exchanges which are there. So the
mm,
interest is definitely there. I think
right.
Indians have a massive appetite to take risk, financial risk, to trade.
Mm,
I think the
right.
two large economies of the world, China and India, the people are the ones who are driven by trading and
Mm,
risk. I think that is built into
yeah.
our DNA for that matter. So we love to take any
Right.
kind of new risk. But yes, for it to become a investable currency where I take it and this is a safe haven, somebody will have to say and tell me that yes, this is safe. वो सरकार को बोलना पड़ेगा, otherwise it's not going to happen.
Well, on that note, Rajiv, that's all I have for today. Thank you very much for the time. It's always a pleasure to hear you speak.
Thank you so much, Karan. And I've been watching your series. Very educational, very helpful. So I'm glad I got to be a part of it. And all the best to you going ahead. And we'll catch up soon.
Thank you very much, Rajiv. You're very welcome.
Take care. See you. Bye bye.